Hi, my name is Jeff DeWees, and I'm the Chief Investment Officer at Oric Capital Partners. Today we're going to talk about the difference between mutual funds and ETFs. Mutual funds and exchange-traded funds, or ETFs, are both pooled investment vehicles, but they have differences in structure, management, and how they're traded. First, trading and pricing. Mutual funds are traded once per day after the market closes. The price is based on the net asset value, calculated at the end of the trading day. All securities values are added up, divided by the number of outstanding shares, and that is the price that everyone gets at the end of the day. ETFs are traded throughout the day on stock exchanges like individual stocks. Prices fluctuate during the day based on supply and demand. It's very possible that you could buy in the early morning and I could come in and buy later in the day and get a different price. Management style. Mutual funds are often actively managed, meaning a portfolio manager selects investments to try to outperform a benchmark. ETFs are typically passively managed, designed to track a specific index like the S&P 500. That said, many ETFs have started coming out over the last few years that have much more active components to them. Cost. Mutual funds may have higher expense ratios due to that active management. They also can include sales loads or fees depending on the share class. ETFs generally have lower expense ratios than mutual funds. However, as I just mentioned, the more active the ETFs get in internal security selection, the higher the expenses get. Investment minimums. Mutual funds often require a minimum initial investment of $500 or more. ETFs have no minimum investment beyond the cost of a single share. Tax efficiency. Mutual funds are less tax efficient because managers frequently trade within the fund with the aim of capital appreciation, which leads to capital gains. These capital gains are distributed typically at the end of each year, regardless how long the investor has held the fund. Later in the year, you definitely need to be mindful about checking a mutual fund's expected distribution before you purchase in a taxable account. ETFs are more tax efficient because they are not required to distribute internal capital gains. Instead, the investor only has a tax liability when they actually sell the fund. Even as they become more active, this benefit holds true. As always, stay calm, stay diversified, and stay positive. From all of us here at Oric Capital Partners, we wish you all a great day.